afternoon and happy Friday. It's Alyssa Corum and Ed Carson here with a look at the stock market today. And on today's show, we're going to be talking about Intel and the chip sector, as well as a look at the software sector looking pretty good, and Tesla not looking too good.
No.
We'll get more into that later, but first let's talk about the major indexes. It was a pretty big week for the NASDAQ, but today small caps led. The Russell 2000 finished with a 1% gain. We had the S&P 500 up 0.4%, the Dow up 0.3%, and the NASDAQ also up 0.3%. But we saw the NASDAQ climb above the 8,000 level this week, and it's now at new high ground. So in that sense, a pretty key week here.
Yeah, pretty key week. I mean, it's not surprising that stocks hit some resistance, and there was a lot of big moves by individual names.
Right, earnings season.
Earnings season, obviously. And, today's action was sort of positive. Obviously, as you said, small caps did well. The advanced decline line, winners outpaced losers, something like 2-to-1. And that was really strong because a couple of days ago, when Microsoft and Facebook rallied, that buoyed the NASDAQ,
Sure.
but underlying, there wasn't as much strength.
Exactly.
So it was a pretty strong day, pretty strong week. Be interesting to see if the S&P can move above. It's almost at those new highs. Dow's not close, not far behind either.
All right, well, we'll keep tabs on that. But speaking of tech, we do want to take a look at Intel today because it dropped some 9% in heavy volume on its earnings report. And, just when we thought chip stocks were starting to do well, I think as of Thursday's close, the chip sector was only behind the software sector as far as year-to-date gains by like 1%. But, we'll have to see how that shakes out. Intel not looking too good here, and growth definitely slowing.
Yeah, slowing a lot. It actually beat Q1 views, though people weren't expecting a whole lot. The real problem was that they warned on Q2 and for the full year. That's a concern because a lot of people said, okay, we know that Q1 is going to be bad for the chip sector, but we really want growth later in the year. There's a lot of expectations there. Intel warned on data centers, so you saw in China, and NVIDIA was a hard hit, but a lot of other chip stocks actually ended the day okay.
Right. We saw a big gap down from Xilinx yesterday after earnings. It was able to reverse a little bit higher today. And we do want to take a look at a chip ETF to give you a broader view of how this group is doing. So the VanEck Vector Semiconductor ETF, SMH, fell for its second day in the row, although it was able to come off of intraday lows.
Yeah, I mean, Intel and NVIDIA are pretty big weights in that index, and you saw some other stocks actually doing okay, like AMD, Broadcom, either slight gains or slight losses, so not too bad. It'll be interesting to see how that goes because, if all these chip stocks start saying, well, we're really not going to see a recovery later this year, I mean, that can't go on because there's been a lot of that expectation, but it'll be interesting to see if that sector can continue to rally.
Right. I'm sure we'll be getting a lot more chip earnings in the coming weeks, so we will definitely be keeping an eye on the results and the guidance to see how the group overall continues to perform. But we want to shift our focus to the software sector, which has been the leading group during this rally in 2019. As of Thursday's close, up 30% so far this year, so some really strong gains. So let's take a look at the software sector ETF. The iShares Expanded Tech Software Sector ETF. Microsoft had a little bit to do with the gains as of late.
Yeah, I mean, it did. I mean, that's a big weight in there. Obviously, Microsoft is basically $1 trillion company.
Right.
So, but there were a lot of great names this week. I mean, ServiceNow gapped out higher. That, I think, revived a lot of optimism. There's a lot of stocks that are close to buy points or actually clearing buy points. So generally, the volume wasn't that high, so I don't want to be too enthusiastic, but generally, if you can see, the IGV really powered ahead this week. That really shows you how that's definitely reestablishing that strength after sort of moving sideways or moving with the market maybe for several weeks. So that's been a source of strength. A lot of breakouts. We'll have to see how that continues.
Yeah, a lot of setups.
A lot of setups, and you're going to be writing about that over the weekend. So definitely check that out. Don't take a break over the weekend. You should be studying stocks, and we're going to have that story out on Sunday.
Yeah, that's right. Stocks to watch featuring 5 software stocks either in buy range or closing in on those buy points. And with it being earnings season, we could see some breakaway gaps on the report. So investors definitely want to be keeping their eyes on those top-rated stocks that are forming bases headed into earnings.
Absolutely.
All right. Well, one stock that is not very highly rated by IBD is Tesla, and we're actually going to look at a monthly chart for Tesla. A huge decline on Friday with the stock losing over 5%. It's now hitting a multi-year low, heavy volume, and I mean, even before today, it's been living below its moving averages. And I think if you take a step back and look at a monthly chart, it's really telling.
Yeah, I mean, it's been terrible basically since the market rally began, and so it really looks bad there. But on a monthly chart, you can see it's wiped out. It's actually, the stock price is basically below where the stock peaked in early 2014, when it had a huge run in 2013 and sort of a second little gasper. But since then, it hasn't done that well. And that blue line, that is the relative strength line, and it has been falling. You can really say it's been falling for a couple of years with a couple of hiccups. It is now at the lowest level since the beginning of January 2014. I mean, a lot of people love Elon Musk. They love Tesla cars, and those are often technical marvels, but you don't necessarily fall in love with the stock. And if you do, this is what can happen.
Right.
It has not been ever. You would be better off if you had, in January 2014, sold your Tesla stock and put it in the S&P 500. Mind you, there were hundreds of other stocks that would have given you bigger gains, but
Right.
it's just not great.
That's the thing. Some people could say, oh, well, it's still about $100 a share higher than it was 5 years ago. But like you said, during that time, the relative strength line has essentially moved sideways. So you would have been better off investing elsewhere. That's why we look at growth stocks with those strong fundamentals. It's always been a problem for Tesla, despite the vision, the actual numbers that they're turning in have been choppy at best.
And choppy at best, and the earnings, and now in hindsight, it looks like some of those earnings in late 2018 weren't sustainable. I mean, slashing capital spending, they did it again, and they still lost a ton. Even some long-time Tesla bulls are finally said, like one said this was a debacle and that Elon Musk and the team seemed to be in like twilight zone. It was really negative, and it's, again, don't fall in love with the stock. Maybe Tesla will come back. If it comes back, don't hate a stock either. If it comes out and delivers strong growth, stock looks strong, that's different. But it is not, and it has not been really for years.
Yeah, and that's why charts are great for a reality check. There might be a company that you really like the story about, have heard some good things about, but look at that chart, get that reality check, make sure you're always balancing out the story with the chart.
Yeah, I mean, I like my Honda, but that doesn't mean I live or die if a Honda stock goes up or down. It's like, if Tesla stock goes up or down, it doesn't mean your Tesla is not a very fine vehicle.
That's right. The charts don't lie, so that's definitely why we're chart nerds over here. All right, everyone. Thanks so much for watching today. We hope you have a fantastic weekend. And if you haven't listened to it already, make sure you catch the latest episode of our Investing with IBD podcast. It's up now. It dropped yesterday, so you can head to investors.com/podcast for all the details on that and how to subscribe. You can listen on your listening platform of choice. With it being earnings season, we definitely are highlighting all the strategies that you can use to buy stocks around earnings season. So we've talked about buying the breakaway gaps and now using options.
Yeah, I mean, that's very useful. I mean, Chris Gessel and Justin Nielsen really went in depth on this. It's a really useful way to try to protect yourself in this crazy season. As you see some big moves, it really shows how that strategy pays off.
Definitely. All right, everyone. Thanks so much for joining us today, and we'll see you back here Monday.